Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. Hi, I'm Michael Bull. Thanks for being with us. We have a great show for you today. And this segment is brought to you by Bull Realty Asset and Occupancy Solutions. Visit bullrealty.com. The name of our show today is Outlook for REITs and Real Estate. Please welcome my first guest, Stephen Mark. Stephen is Managing Director with Fitch Ratings, and he's joining us on the phone. Stephen, thanks for being with us.
Michael, thank you very much for having me.
And Stephen, so if you will, share with us first, how did 2017 wrap up overall for REITs?
Well, 2017 not so hot for the sector. It when compared to the broader indices, for instance, the S&P 500, REITs underperformed from a total return standpoint by about 25%, and already this year there's a gap in performance already just out of the box by another 11%. So it's been rough going for the REIT sector over the last 15 months or so.
And why is that, Stephen? Because I think from a commercial real estate audience would think, wow, commercial real estate's been doing well.
Right. I think this is an instance where perhaps that the fundamentals are delinking from stock market, public market valuations. It's been a combination of two things. One is the increase in interest rates, which there's generally a perception that in a rising rate environment, that's generally bad for REIT stocks, and at least early on in a rising interest rate cycle, that historically has been the case. REITs, however, do typically tend to outperform the broader market once rates begin to stabilize. But I think the general consensus is we're not there yet. We're still in a rising rate environment, and there's expectations of that continuing, and I think that's one reason. Second reason is I think there's a general consensus, and we'd be on board with that, is that fundamentals are at the tail end, the latter stages of the cycle. So in an environment where there's probably less property level cash flow growth, and at the same point rising interest rates and hence probably rising cap rates as well, it's not good for commercial real estate valuations, and hence that's bad for the stocks. And probably the third reason is there are other alternatives out there. There's other stocks to invest in other sectors, and so from a relative valuation standpoint, other sectors are looking more attractive as well.
Yeah. Well, it makes sense when you mention the cycle, rising rates. What about sectors, though, Stephen? Are there certain sectors of REITs in 2017 that maybe fared a little better?
Some of the non-traditional sectors, such as the data centers, the towers, continue to do well, and that's likely driven just by the fact that that's one of the few areas within real estate, if you want to consider those asset classes, quote unquote, real estate, where there's still tremendous secular growth behind them, good tailwinds, and certainly technology and most things related to that are one of the more growthy parts of our economy, and so that's one way to play that. Whereas the more traditional kind of core asset classes, where there's probably a better defined supply-demand dynamics out there, it's fair to say that in most of those cases, for most of those sectors, it feels like we're at the latter stages of the cycle.
Okay. What about moving forward, Stephen? We've just had this recent Tax Act, Jobs Act and Tax Act that has made some changes. Is that potentially going to impact REITs moving forward?
We think there's shifting sands. There's some positives and some negatives. I think first on the positives, certainly to the extent that there is companies, corporations, to the extent they're able to repatriate some cash back to the U.S. and have lower tax rates, they're likely to spend some of that in terms of growing their companies. Certainly, they'll probably devote some of that capital towards share buybacks. But to the extent that they do reinvest in their businesses and grow their businesses, almost regardless of the industry that they're in or the asset class that they're in, that's generally good for commercial real estate demand. And then secondly, to the extent that individuals have had some tax benefits, then from that standpoint, there's probably increased demand as well. Having said all that, these things typically don't really materialize for commercial real estate for 18 to 24 months, given that commercial real estate is more of a lagging indicator typically. So wouldn't expect these benefits to filter through to fundamentals for at least 18 to 24 months.
Okay, so what do you expect moving forward? We're talking with Stephen Marks, Managing Director with Fitch Ratings, about REITs and the outlook. So what do you expect for 18 and maybe into 19?
Sure. Yeah, our outlook, and I'll speak primarily to on the credit side, which is the area that we focus on. We have a stable outlook on the sector for 2018, driven by a couple things: relatively unchanged leverage and coverage metrics at the entity level. Companies still have pretty good liquidity and access to most forms of capital. Development is up a little bit, but still relatively muted, and there's not many pockets where we're seeing overdevelopment, either from an overall sector standpoint or exposures from individual companies. Those are the positives in terms of our outlook. Some of the things that balance that, as I mentioned before, we are towards the latter end of the cycle, such that valuations have probably peaked already. Shares, because of that, and we talked about the stock market a little bit, many of the company shares are trading below net asset value at this point, so it makes it less appealing for them to issue equity, and then on the flip side, it makes it more appealing to buy back stock, which is generally a credit negative.
Okay, what about foreign investors, Stephen, or anything in the tax changes or the economy or the world economics that would benefit REITs or maybe not moving forward from foreign investors?
There hasn't been anything, I'd say, in the last 6 months that has caused us to say that there's going to be a big shift in terms of foreign investment in the U.S. When the FIRPTA rules were changed about 2 years ago, were rules that were designed to basically loosen some of the regulations around foreign investment in the U.S. It kind of kick-started or continued a trend of continued investment in the U.S. I think one area, you have to kind of look at the individual countries in some cases. China had been a sizable investor in U.S. commercial real estate. That's tailing back a little bit. Other countries or other regimes, sovereign wealth funds, continue to have a tremendous amount of capital. Some of the oil-rich countries in the Middle East, for instance, continue to invest material amounts of capital. So our sense is that it's probably going to be down a little bit, but still very robust.
Yeah, okay. What might be a shock to the REIT world, maybe positive or negative, that could change your outlook?
I'd say hit the negative side first before the positive. One thing that we're increasingly concerned about is the extent of mortgage availability for various asset classes. And to the extent that, and we're certainly not predicting this by any stretch, but it would be one thing that we're keeping a closer eye on is to the extent that insurance companies pull back from certain asset classes or certain sectors, how does that then affect what we consider the contingent liquidity, the availability of getting a mortgage on an unencumbered asset and then being able to use that capital towards other channels within a company. One place where we have seen it is in the B mall space, the less productive malls that just cannot find traditional CMBS or insurance company mortgage availability, and hence it really hurts some companies' contingent liquidity. Haven't really seen it in many other sectors, but you could certainly see it working its way up from kind of the bottom to where it could eat into some companies' access to capital. That's on the kind of a shock to the negative. A shock on the positive could be look. If interest rates kind of stay where they are, or maybe even go down. Interest rates are very fickle. For the last 7 or 8 years, everyone had been predicting rates would go up, and they really didn't. In fact, they went the other way. It feels like the consensus is that rates are going to increase again, but they may not. They may actually go back down. That would certainly be a benefit for commercial real estate valuations.
Okay, and you mentioned the availability of financing, and the Fed has recently come out and said that commented that possibly real estate is overvalued right now, and if banks are taking heed of that and maybe tightening it up their standards moving forward, do you guys feel like some real estate asset classes are overvalued at the moment?
I wouldn't say overvalued at this point. Certainly, that there's been a tremendous amount of capital dedicated towards commercial real estate, but not feeling that there's overvaluations at this point. Although having said that, cap rates are sticky. They tend to not move in lockstep with rises in interest rates, and so we feel like valuations probably peaked a while ago. but not feeling that there's anything really overvalued at this point.
Yeah, I agree with that. I think it seems like the fundamentals are strong. If we're going to have the continued job growth and the money coming back from repatriation, if we're going to have companies with more money in their pocket, hiring more people, hopefully REITs and everyone else is going to do the Snoopy dance moving forward. Stephen, any closing thoughts for our audience?
No, don't think so. I guess the only thing I would just add on that last point is that we've seen a lot more discipline in the system over the last 10 years. CMBS, LTVs, and kind of the numbers that we look at, much more conservative, a lot more equity in deals, not as many merchant developers that are building on spec. The overall system, it feels like, is in a much better place. So to the extent that there are declines in valuations, it doesn't feel like the sector is going to be under the microscope like it was back in 08, 09.
Yeah, a good point. I agree. It's a lot different. None of us expect the downturn like we had in the past in 09. Well, Stephen, thanks for joining us. Great information as usual.
Yep, thank you very much, Michael.
All right, and stay with us. We'll have more on the REIT Outlook and Real Estate Outlook after this short message. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.